Now, using derivatives is risky. Uncle Warren basically is attributed. Now, no, seriously, I am related. He's my grandfather's brother's husband's second cousin's sister, his father. He plays a hell of a game of bocce, though. He won 20 bucks from me one day. But anyway, Uncle Warren is attributed to saying this, okay, which is interesting because if you study Warren Buffett, he is one of the biggest users of derivatives in the world. Well, wait a minute. I thought he said that derivatives are financial weapons of financial mass destruction. Why is it that Warren Buffett uses derivatives? Well, what Warren Buffett was talking about was a type of derivative that's different than what he trades and what we trade. So let's go back to our type of risk, and I want to come down here to counterparty risk, if you can see that at the bottom. And let's talk about what counterparty risk is. When Lehman went under on September 15th, 2008, what we had the market just collapse after that. And really what we had, the reason why Lehman Brothers went out of business, and there's some really great movies. Inside Job is a wonderful movie that really does a good case in explaining this. But Lehman Brothers was packaging mortgages, and they were packaging mortgages that people that would fog a mirror on. And they really were perpetrating, they were asking the street, just give me signatures. And they were creating these pools. But Lehman is not stupid, as Goldman wasn't stupid. They knew that there was a lot of garbage in these pools, these mortgages, they rubber band mortgages together, and then they would securitize them and they would sell them to the world. And every sovereign wealth fund. And then what's interesting is they were getting a monoline insurance company like Moody's or S&P, so they had a AAA rating on them. So they went to get them insured, they went to a company called AIG. Now AIG is was the largest insurance company in the whole world. And they said to AIG, hey, can you give us insurance on this so we can sell this to Dubai, and we can sell this to Germany, and we could sell this to public and private pensions. And so they said, sure, give us a premium and we'll sell you insurance. It's an insurance policy, credit default swap. And the problem with this is that it's a private transaction. There's no, okay, how many people have lent people money in here? Okay, how many people have actually got their money back? Okay, because I'll put my hand out, okay? Because, you know, I don't understand that. I actually bumped into a guy at the store the other day, and I go, hey, you owe me money. He goes, yeah, I know I do. I go, well, okay, good. Life is good. Yeah, life is good. And he goes to church. I say, well, that makes sense. No, but okay. Okay. So anyway, it's a private transaction. So to eliminate the problem of people owing you money that don't pay, and AIG said, I don't have the money to pay you, there was exchanges created. And what is an exchange? An exchange is that if I buy and then the other person sells, whether it could be a stock on margin, whether it could be an option or a futures contract, the seller of insurance has to put up margin. And what that simply is, that they have to put money at this exchange, the bank, and that if it goes wrong and this person that owes this person money takes off to, I don't know, Hoboken, New Jersey, then this guy is not going to have to go look for him. He just goes to the exchange and collects the money. That's called counterparty risk. And when Warren Buffett was talking about weapons of financial mass destruction, he was talking about derivatives that are over the counter, that are private transactions. Now, there's been a lot of legal wranglings and a lot of government. Frank Dodd tried to pass laws to really put all these derivative contracts on an exchange. In fact, there's a movie that I want everybody to watch in the back, and it's called The Warning, and that's for you guys. Take a copy of it. It does a wonderful job of explaining how in 1998, Brooks Lee Braun of the CFTC basically said, we need to put these things on exchange because they're weapons of financial mass destruction. And the Clinton administration and his merry men, Robert Rubin, who was the CEO of Goldman and then Citibank, did not want to regulate derivatives and did want to get rid of Glass-Steagall. And really, the seed of the '08 financial crisis was born right then. Getting rid of Glass-Steagall and not putting these on an exchange. We would not have had what happened. And so that's the problem. The private transaction. I am for all derivatives on an exchange. So over the counter, there's no counterparty, there's no transparency, there's no orderly market, there's no mark to market. Okay, solution is let's put it on an exchange. But the problem is there's something at banks called prop trading, and prop trading is how banks make a ton of money, and they make a ton of money selling over-the-counter derivatives. Let's think about this for a second. I call up a bank, I go, listen, I need to insure, I got a mortgage pool, I need to insure, and he says, I'm not feeling too good today, my wife just bought a Mercedes, so I'm going to charge you X. And then I call up the next day and I get charged Y. They're putting spreads on those trades between the bid and offer that you could drive a truck through. And that's where they make their profit. They sell and they buy. And with an exchange, what happens to these spreads? They come in and it kills the profit. If you look at exchanges today, like if you trade the SPY, the SPX, those spreads are very, very tight. 1 penny. And that means it's taken all that profit out of it. If you go to the Chicago Board of Options and you walk through the pits, everybody's gone. It's gone electronic. It's gone to the point where those traders used to make all this money on all those spreads, and computers have taken those spreads and they've put them here. And they have gone out of business, but it's benefited the community, it's benefited the global economy, and it's benefited all of us because now we have a fair and orderly and regulated market. Bankers don't like regulation. Okay, Wall Street doesn't like regulation because they're thieves. They're thieves. See, I was going to talk about the history of banking. I just ripped them all up. But you guys wanted to hear this stuff, but that's cool. So anyway, my premise is that they're not weapons of financial mass destruction. Okay, they are not. Okay, my fifth proof is using derivatives to manage money is too costly, too risky, and a waste of money. Okay. Well, this is...